Good day, FAC2602 students. Welcome to yet another lesson. I know that it has been quite some time since I've uploaded any lesson on my YouTube channel. But nonetheless, here we are. Today's lesson will cover Assessment 1 of Semester 1 for 2023. As you should know by now, FAC2602 has been changed to a continuous assessment module as of the 2023 academic year, which basically means that you will not have to write a final examination for this module. Instead, you have 4 assessments per semester, 2 of which will be quizzes and the other 2 will be written assessments. And each of those assessments will contribute a certain percentage towards your final mark. Now, semester 1, assessment 1 contributed 10% to the final mark for semester 1 students, so it should be the same weight for this semester as well. It counted a total of 25 marks and addressed learning units 1 to 5. So please ensure that you work properly through each of those learning units before the assessment takes place on the 22nd of August 2023. That is according to the latest information that I have received on the FAC2602 Telegram group. Assessment 1 is a written assessment, and for semester 2 it will open on the 22nd of August at 6 p.m. and the cutoff time will be 9 p.m. The lecturers will communicate with you regarding invigilation, but for the first semester's assessment 1, the assessment was not invigilated. I would also like to warn those students who want to make use of third parties to, write the assessment on their behalf. Please refrain from such practices. I have received numerous requests in the past to help students complete official assessments. Please note that I will reject any such request made, as that would be unethical conduct that goes against the students' code of conduct of the university. Alright, but I'm not here to talk about the administrative procedures for assessment 1. I would like us to concentrate on how the assessment will look and what you will be required to do in this regard. Okay, so assessment 1 should look more or less like the first semester's assessment 1. You will be given an extract of information about a group. Right, and the required section will require you to draft the group's financial statements. Please note that according to or because of the time limit of the assessment itself, you will not be required to draft all 3 financial statements in full, meaning that you will not be required to draft the consolidated statement of profit or loss and other comprehensive income, the consolidated statement of changes in equity, as well as the consolidated statement of financial position, each of those in full. According to this assessment, students were required to draft the consolidated statement of profit or loss and other comprehensive income, as well as the consolidated statement of changes in equity in full, but only the total assets section in the consolidated statement of financial position. So it is important for you to carefully read your required section. And as you should have noticed from my previous lessons as well, I always look at the required section first. Before you even start reading through the extract that they have given you, please go to your required section first and take note of what you are required to do. This will help you to avoid wasting time on, for example, journal entries that were not required. Now that we talk about journal entries, alright, I've also received questions in the past relating to your consolidated journal entries or your pro forma consolidation journal entries. For example, the elimination of owner's equity at acquisition. Alright, will we be required to always draft that specific journal entry or other journal entries? The short answer is no. You are only drafting those journal entries when they are specifically required in the relevant question. Okay. And for this type of question where you need to draft the group's financial statements, please note that your journal entries are not required. Okay, so please do not waste time on drafting those entries. However, All right, and you should notice this from my suggested solutions. Please, guys, please note that those solutions are not the official solutions that are used by the lecturers of FAC2602 in order to mark your assessment. It is just my own version of possible solution to the question itself. So I can make mistakes, and I'm always open for debate. If you are or if you come across something in my suggested solution that you do not agree with, you're more than welcome to engage with me in a debate. I will be happy to accommodate you in that regard. Alright, but as I was speaking about the journal entries, you only draft them when they are required, and as you should notice from my suggested solutions, I always include specific journal entries that help with the elimination of intergroup transactions. However, intergroup transactions and the elimination of those transactions will be dealt with in more detail in later learning units. For the first assessment, the elimination of intergroup transactions will not be that significant. Alright, they would just want to test you if you are able to draft the group's financial statements after the date of acquisition. Alright, because there can be a situation where the group was formed in the current year as well, and then you will have to calculate a pre and post acquisition profit for the subsidiary. But again, that is addressed in Learning Unit 6, so it falls outside the scope of Assessment 1. Okay, so let's get to the actual question. Question 1, okay, the assessment only contains one question for 25 marks. You are required to draft the following statements or prepare the following statements for the Prospectus Limited Group for the year ended 28 February 2023, and I have already mentioned those statements. Also, pay attention to your please note section. Your answer must comply with the requirements of International Financial Reporting Standards. Notes to the consolidated statements and comparative figures are not required. Round off all amounts to the nearest rand and ignore the taxation effect on unrealized profits and or losses, capital gains tax and dividends tax. As I have already indicated, the elimination of intergroup transactions will be addressed in Learning Unit 7 of FAC2602. So that will not really be assessed in Assessment 1. Okay, so you can actually disregard the last point. They will not they are not likely to include any intergroup transaction where there is an unrealized profit on, for example, an intergroup sale of inventory or an item of property, plant and equipment. Okay, you need to go through Learning Unit 7 to see how those transactions are dealt with. But for Assessment 1, those principles will not be tested. Again, the main purpose of Assessment 1 is to test your ability to draft the group's financial statements after the date of acquisition. So are you able to correctly draft the analysis of owner's equity? Are you able to eliminate common items? Are you able to eliminate owner's equity at acquisition? Meaning, are you able to eliminate the parent's investment in the subsidiary line item against the equity balances of the subsidiary at acquisition? But we'll get to that as we work through the question. Okay. Just want to make sure that it is recording. So let us get started. Okay, so we need to draft all of those statements except for number C, where we only need to draft the total assets section. So now we can actually start reading through the scenario that they have given us. It says the following. Prospectus Limited acquired 70% of the shares in Reed Limited on the 1st of March 2022. Both companies manufacture spare parts for motor vehicles, and then they give an extract of the financial statements for those two companies for the year ended 28 February 2023. Now, before we proceed to additional information, we need to take note of certain important points. Okay, firstly, we need to distinguish between the parent and the subsidiary. Firstly, okay, it is important from the group's perspective in order to distinguish between those two entities correctly. Now, there are numerous ways that you can do this. The first way in which you can do this is by going to your required section. We are busy drafting the group's financial statements for the Prospectus Limited Group, which basically means that Prospectus Limited is the parent, because remember that the group is named after the parent. So in this question, Prospectus Limited will be the parent and REIT Limited will be the subsidiary. In FAC2602, we only deal with simple groups, meaning those are groups that only consist of a parent and one subsidiary. Also, for the purpose of FAC2602, we know that the parent must own a majority of the ordinary shares in the subsidiary in order to have control. Okay, the detailed principles of control are briefly addressed in Learning Unit 1 of FAC2602, but it will be addressed in more detail in FAC2764. Or the principles of control will be expanded on in FAC2764. For this module, we only need to look at the number of ordinary shares that are owned by the parent. If the parent owns a majority of ordinary shares, and each of those ordinary shares have one voting right or has one voting right attached to them, then we know that the parent has control, and where the parent has control, we know that the group is formed, which means that we have to draft consolidated financial statements. In other words, consolidation is required. I just want to mention that investment in associates and joint ventures where there is not necessarily control of one entity over another, but there can be significant influence. Those are addressed in Learning Units 11 and 12. Alright, the rest of the Learning Units of FAC2602 focus on consolidation or groups. Okay, in other words, where the parent controls the subsidiary. So that is the first way in which you can distinguish between the parent and the subsidiary, is by looking at your required section. The group is named after the parent. The second way in which you can determine this is by looking at your extract of the financial statements. The parent's figures will always be listed first, and then those of the subsidiary. So in this question, the extract first shows Prospectus Limited's records, and then those records of REIT Limited. So we know Prospectus Limited is the parent and REIT Limited is the subsidiary. In this question, we do not have to calculate the percentage interest that the parent has in the subsidiary's ordinary shares, because that percentage has been given as 70%. And since it exceeds 50%, so Prospectus Limited has a majority shareholding in REIT Limited's ordinary share capital. So therefore, the group is formed because Prospectus Limited is assumed to have control over REIT Limited. This will also be confirmed in your additional information. Okay, and then we just need to take note of our current financial year. According to our required section, we are preparing the statements for the year ended 28 February 2023, which means that our current year has started on the 1st of March 2022, as I've indicated here. And then you just need to take note of your date of acquisition. That will be especially important in later learning units. But for this question, the date of acquisition, so the date on which the group was formed, is the 1st of March 2022, the beginning of the current financial year. In Learning Unit 6, as I've also mentioned briefly, the group can be formed in the current financial year. So for instance, if the group was formed on the 31st of July 2022, we know that the 31st of July 2022 falls within the current financial year. So therefore, you will have a pre-acquisition period as well as a post-acquisition period. Again, we will not focus on those principles in this lesson. Those principles will be addressed in Learning Unit 6 and will be assessed in later assessments. Okay, for this question, the date of acquisition is the 1st of March 2022. So in our analysis of owner's equity calculation, we will always have an at acquisition section. So the at acquisition section will be on the 1st of March 2022. And then we will have a since acquisition, so since the 1st of March 2022 to the end of the current financial year, which is the 28th of February 2023. Okay, in this question, you will not have a since acquisition to the beginning of the current year section, because the date of acquisition is the same as the beginning of the current year. So it will not make sense if you have a since acquisition, which is the 1st of March 2022, to the beginning of the current year, which is also the 1st of March 2022. Alright, so in your analysis of owner's equity for ordinary share capital, alright, you will have an at acquisition section as well as a since acquisition to the beginning of the, or to the end of the current year section. Okay, to the end of the current year. Okay, so before we get to the additional information, we first need to start drafting our analysis of owner's equity calculation. Okay, this is the basic layout for this particular calculation. As I've said, we have an at acquisition section, which is the 1st of March 2022, and then the parent we have determined to be Prospectus Limited, and then we also have non-controlling interests. Your non-controlling interests are basically the minority shareholders or the non-controlling shareholders of the group. And according to your background information, the parent has 70% shareholding in the subsidiary's ordinary share capital. So therefore, the percentage that we apply in the analysis of owner's equity calculation will be 70%. So if the parent owns 70% of the ordinary share capital of ordinary shares, then your non-controlling interest will take up the remaining 30%. Just for you to take note of, if you want to calculate the percentage interest of the parent in ordinary share capital, we take the number of ordinary shares owned by the parent and we divide that by the number of ordinary shares that were issued by the subsidiary. Okay, but in this question you did not need to calculate the percentage interest because it has already been given. Okay, so just take note of that calculation as well. It is important for you to calculate this or these percentages correctly, because otherwise your allocation between the parent and non-controlling interest will be incorrect. And remember that your allocation will also affect the calculation of goodwill, which we'll get to as we work through the question. Okay, so according to our extract, we first go to the investment in subsidiary line item. So that will be this item right here, the investment in REIT Limited. And in FAC2602, we assume that the investment in subsidiary amount equals its fair value, which is also its original cost. So in other words, the cost of the investment in subsidiary is also equal to its fair value. There has not been a change in fair value since acquisition, which basically means that you will enter this amount as displayed in the extract in this line right here. Okay, consideration received from the parent for its investment in the subsidiary amounts to 3 million rand. And as you enter an amount, you can just cross that particular amount out in your additional information. Okay, so your consideration received from the parent is 3 million rand. That will be entered right here in your analysis of owner's equity calculation. Okay. And then we can proceed to additional information, which says the following. Now, the first point will normally give you the equity balances of the subsidiary at the date of acquisition. All right. You will notice that as you work through FAC2602 practical exam type questions. Now, on the acquisition date, which was the 1st of March 2022, remember that the 1st of March 2022 is also the start of the current financial year. Okay. REIT Limited's other components of equity amount to 100,000 rand. The carrying amount of REIT Limited's assets and liabilities were deemed equal to the fair value thereof on this date, which means that we do not have to make any adjustments to any of the equity balances at acquisition. Each share of REIT Limited carries one vote, and voting rights alone determine control. And I have explained this part as well. In FAC2602, we focus on the percentage shareholding that the parent has in the subsidiary's ordinary share capital, because those shares, that being ordinary shares, each has one voting right attached to them, and voting rights alone determine control. So in other words, if the parent owns more than 50% of the subsidiary's ordinary shares, we can say that the parent also owns a majority of the voting rights attached to those shares, and therefore is able to control the subsidiary, so the group is formed. Okay, this is just general information that you need to take note of. Okay, so let us enter the equity balances for REIT Limited at acquisition in our analysis of owner's equity calculation. So for share capital, all right, the issued share capital of both companies remained unchanged since acquisition, which basically means that for REIT Limited, the subsidiary, the ordinary share capital balance at acquisition is the same as the year-end balance that is given in the extract, because there has not been any change since the date of acquisition. So in other words, the balance at acquisition of share capital ordinary shares for the subsidiary was 800,000 on the 1st of March 2022, and this is also the balance at year-end in REIT Limited's records. So we'll enter that amount right here. Ordinary share capital 800,000. Then we look at retained earnings. The retained earnings balance is given as at the 1st of March 2022, the date of acquisition. For the subsidiary, it was 3 million rand. And then your other components of equity, which for FAC2602 will normally consist of revaluation surplus only, amounted to 100,000. Right, and according to additional information point 1, the carrying amount of the subsidiary's assets and liabilities were deemed equal to the fair value thereof on the acquisition date, which means that we do not have to adjust any of the equity balances at acquisition. Okay, now you'll notice in this section that goodwill is calculated automatically through a formula that I've inserted in this calculation. However, many of you seem to be struggling with the calculation of goodwill. So if the total consideration received from the parent, which in this case is 3 million rand, is more than the total net asset value of the subsidiary's assets and liabilities, or the subsidiary's equity. So if the total net asset value attributable to the parent at acquisition is less than the total consideration received, so in other words, the parent paid more than it should have paid for its investment in the subsidiary, the difference between these two amounts will give you goodwill. And if it's the other way around, so let's say the consideration was less than the net asset value attributable to owners of the parent, then you will have a gain on bargain purchase. And this will be, or this type of scenario will be addressed in FAC2764. In FAC2602, you will either have an acquisition at net asset value, which means that your net asset value for the parent, the 2.73 million, is the same as the consideration received, which means that your goodwill is 0, or there's no purchase difference. And the other scenario that you can have, such as in this case, will be where the consideration received exceeds the net asset value of the parent, and the difference then is calculated as goodwill. And remember that goodwill is 100% attributable to owners of the parent. As you should notice, no portion is allocated to NCI, so the total column should be 270,000, of which 100% goes to the parent. Alright, now just for completeness, I would like to show you the elimination of owner's equity at acquisition. So how do you eliminate the owner's equity at acquisition? That will be done as follows. We will debit the equity balances of the subsidiary at acquisition. So you will debit share capital for REIT Limited. The balance was 800,000. You will debit retained earnings for REIT Limited, and the balance was 3 million. Okay. Remember that goodwill, where applicable, should be displayed or disclosed as a non-current asset in the consolidated statement of financial position. Alright, so we will debit goodwill, or let's say rather we will debit revaluation surplus or other components of equity as given in additional information point 1, other components of equity. The balance there was 100,000. And then you have a non-current asset for the group, which is goodwill, 270,000. Again, goodwill has been calculated as the difference between the consideration received from the parent, 3 million rand, the investment in REIT Limited, and the net asset value that is attributable to the owners of the parent, which was calculated in the analysis of owner's equity at acquisition as 2.73 million rand. Okay, that will be the sum of these three amounts. Okay, remember that the total amount will be split between the parent and NCI according to these two percentages, or according to this ratio right here, 70 to 30 or 7 to 3. Alright, so please take note of that calculation. Then you will credit the investment in REIT Limited as reflected in Prospectus Limited's records of 3 million rand, and then you will credit non-controlling interests. So you will now have an equity balance on the statement or on the consolidated statement of financial position, as well as the consolidated statement of changes in equity. So non-controlling interests will amount to 1.17 million. Okay, this is the elimination of owner's equity at acquisition. I just want to make sure that our journal entry balances, and it does. Alright, 4.17 each. Okay, so remember again, this was not required in this question. It's just for you to see how you are supposed to eliminate the owner's equity at acquisition. So in your consolidated statement of financial position, the share capital of the subsidiary should not be included because it has been eliminated as part of this journal entry right here. Okay, so with respect to share capital, okay, remember that the issued share capital of both companies remained unchanged since acquisition or since the beginning of the current year. Okay, so in your consolidated statement of changes in equity, pardon me, the opening balance for the group's share capital will only be that of the parent. Okay, that being 600,000. So in your consolidated statement of changes in equity, you will have a balance as at the 1st of March 2022. Share capital for the group will only be that of the parent, which is 600,000. And this will also be the balance at year end, which is the 28th of February 2023, 600,000. There has not been a change in share capital of the parent since acquisition. Okay, and remember again that the share capital of the subsidiary was eliminated. So you cannot have 1.4 million, so that being 600,000 plus 800,000 as the group's share capital, because you have eliminated the subsidiary's equity at acquisition against the investment in subsidiary line item. So your share capital column in the consolidated statement of changes in equity should only include those amounts relating to the parent. The year-end balance has been given as 600,000, right? Because this extract is for the year ended 28th February 2023. So this is the balance on the 28th of February. And according to additional information point 1, the issued share capital of both companies remained unchanged since acquisition. So the year-end balance should also be the opening balance for this year. Okay, the balance as at the 1st of March 2022. Alright. The same will go, or the same principle will apply to retained earnings. The retained earnings balance on the 1st of March 2022 was 3.5 million for the parent. So this will be the opening balance for the retained earnings column in the consolidated statement of changes in equity. The corresponding balance of the subsidiary, that being the 3 million rand, has already been eliminated. Please also take note that if you have a since acquisition to the beginning of the current year section in your analysis of owner's equity, alright, you will also need to take into account the change in retained earnings as part of your calculation of this opening balance. Okay, but I have addressed such a calculation in many of my lessons that I've uploaded on my YouTube channel, so please go have a look, where you will have where you have a since acquisition to the beginning of the current year section. You calculate the change in retained earnings. So you will take the balance as at the beginning of the current year, and you will subtract the balance at acquisition. The change in retained earnings will need to be split between the parent and NCI. Okay, and this amount that you get here will be part of the calculation of the retained earnings balance for the group as at the beginning of this year. Okay, but in this question that will not be the case. The opening balance for the group's retained earnings will only be that of the parent as at the 1st of March 2022. The retained earnings balance of the subsidiary on this date has already been eliminated. Okay, this is just for simplicity purposes. And then your non-controlling interest column, or revaluation surplus, let's have a look at that one as well. Do we have a revaluation surplus line item? Yes, we do. We have other components of equity. All right. For the parent, it was 450,000 as at the 28th of February 2023. And any absence of any further information, you may assume that there has not been any change in that specific item. So the other components of equity for the group as at the 1st of March 2022 will also be 450,000. Okay, again, the other components of equity for the subsidiary, okay, that being the 100,000, has already been eliminated as part of this journal entry. Okay, the elimination of owner's equity at acquisition. So it should not be included in the opening balance for revaluation surplus or other components of equity for the group. Okay, it's very important that you pay attention to that calculation. All right, and then remember, as I've said, goodwill is a non-current asset, okay, for the group. So in your consolidated statement of financial position, remember we are required to draft the total asset section. So goodwill, which we have calculated as the difference between 3 million and 2,730,000, should give you 270,000 for the group. As you should notice, the investment in REIT Limited should not be disclosed in the consolidated statement of financial position. Why? Again, it is eliminated as part of this journal entry. And remember that the investment in REIT Limited represents a common item. Okay, all of these should represent common items that are eliminated against each other. All right, as part of the elimination of owner's equity at acquisition. So your goodwill for the group as at the 28th of February 2023 amounts to 270,000. All right. Okay, so let's proceed to part A. Now that we have drafted the at acquisition section for the analysis of owner's equity, let us start drafting the group's statement of profit or loss and other comprehensive income, which is from my template. So you will start with revenue. Okay, for the parent it was 7508, and then for the subsidiary, remember that revenue can have intergroup sales included. Okay, again, intergroup sales of inventory will be addressed in Learning Unit 7. But where there has been intergroup sales of inventory during the year, you will need to eliminate the intergroup sales for the current year. Okay, but for this case, to calculate the group's revenue, we will only need to take the revenue for the parent and we add the revenue for the subsidiary. Okay, there are no common items that we need to eliminate for consolidation purposes. Okay, so the revenue for the subsidiary was 7930. Okay, so revenue for the group for the current year amounts to 15,438,000. Okay, then we look for cost of sales, 3,003,200. So 3,003,200 plus cost of sales for the subsidiary 3,140,000. Okay, remember you need to subtract this from revenue. So 3,003,200 plus 3,140,000. So that will give you 6,143,200. Okay, and then we need to look at our additional information first. According to additional information point 2, dividends received is included in other income. Remember that because the parent is actually a shareholder of the subsidiary, if dividends were paid by the subsidiary during the year, a portion thereof is an intragroup portion, meaning that is a portion that was paid within the group to the parent. Okay, so what I mean by this is if you look at the total dividends paid by REIT Limited, which is 90,000, a portion thereof, actually 70% of that dividend, was paid to the parent. Okay, because the parent is actually a shareholder of the subsidiary, so it will be entitled to dividends if declared and paid. So in your analysis of owner's equity, we first need to calculate the dividends paid by the subsidiary to non-controlling interest and the parent respectively. Remember, for the purposes of this question, we will not have a since acquisition to the beginning of the current year section. Instead, we will have a since acquisition to the end of the current year section, where you will have the profit after tax. Preference shares or preference dividends are only addressed in Learning Unit 9 of FAC2602, so we will ignore any portion dealing with preference dividends. Your ordinary dividend paid or declared and paid by the subsidiary amounts to 90,000, and as we should know, we should split this between the parent and non-controlling interest based on the percentage shareholdings. Alright, so of the 90,000 worth of dividends that was paid by the subsidiary, or that were paid by the subsidiary, 63 has been paid to the parent and 27,000 has been paid to non-controlling interests. Alright, remember, because we have an intergroup portion, it must be eliminated for consolidation purposes. Alright, and I should mention that the specific elimination of dividends, or the treatment of ordinary dividends during the process of consolidation, is addressed in Learning Unit 8 of FAC2602. So for the purposes of Assessment 1, you should only be able to identify an intergroup dividend that was paid and take it into account when drafting the consolidated financial statements. But I would just like to show you the journal entry that you will draft in order to eliminate the intergroup ordinary dividend. So the elimination of intergroup ordinary dividend and recording the NCI share in that dividend right? So we will do that as follows. Firstly, according to additional information point 2, the dividends received by Prospectus Limited from REIT Limited is included in other income. So if you look at other income for the parent, which is 380,000, this amount includes the dividend of 63,000 that was received from the subsidiary. And since it is an intergroup dividend, in other words, that group cannot pay dividends to itself. Okay, I would like you to think about it in this way. The group cannot pay dividends to itself, so that portion must be eliminated for consolidation purposes. And while you are doing this, you need to record the NCI share in that dividend as well. So we will do that as follows. We will debit other income for the parent, because this is the line item that includes the intergroup portion of 63,000. How did we calculate 63,000? We took 70% and multiplied this with the total dividends that were paid by the subsidiary. Alright, 70%. You will also debit NCI or non-controlling interests. Okay, and this component will be shown in the consolidated statement of changes in equity. Alright, 27,000, 30% of 90,000, and then you will credit the dividends paid line item that is shown in the subsidiaries records. Okay, 90,000. So in your extract, you can cross out dividends paid by the subsidiary, 90,000. All right, and we can proceed making the necessary adjustments. So in your excuse me, in your consolidated statement of profit or loss and other comprehensive income, you will start with the amount of other income that was given in the extract for the parent, which is 380,000, plus other income for the subsidiary, which is 185. All right, and then you will subtract the intergroup dividend, so that dividend that was paid by the subsidiary to the parent, so that being 63,000, because we debit other income, so we will show this as a reduction in this calculation. So minus 63,000. So if you're unsure whether to add or subtract a certain amount, briefly draft your relevant journal entry and see what adjustment is necessary in this regard. Okay, so we will take 380, the amount for the parent plus the amount for the subsidiary, minus the intergroup portion, okay, of that dividend that was recorded in other income. So other income for the group is actually 502,000. Okay. All right, then we just need to look at your other income and expense items. So we will have other expenses as well, or I'd like to refer to that as administrative expenses. So 480,000 plus other expenses for the subsidiary, which is 375. Okay, again, the same principle applies to other expenses as well. If there was an intergroup expense, this must be eliminated. For example, if the parent pays rental expense to the subsidiary, okay, the rental expense will be recorded in the parent's records, okay, because this has been paid by the parent. Whereas with the subsidiary, it will be recorded in its other income. And because this is an intergroup amount or a common item, we need to eliminate those two amounts against each other. But in this question, that will not be the case. There is no intergroup expense that we are required to eliminate for consolidation purposes. Right, so the administrative expenses for the group will just be that of the parent plus that of the subsidiary, which will give you 855,000. Okay. Then we have finance charges or finance costs, which will just be the sum, again 50 plus 30, because there's no intergroup portion that we need to eliminate or take into account. So finance costs for the group. Ladies and gentlemen, please also ensure that you show your calculations and that you reference each of those amounts that you have calculated. It just makes the marking process so much easier for the lecturers, okay, if you have referenced all your calculations. Okay, so we have taken into account finance costs or finance charges, and then we have income tax expense, which is 1209 or 1219 344, plus the income tax expense for the subsidiary, which is 1257,200. Okay, this will also be subtracted from the profit before tax. So 1219,344 plus 1257,200. All right, we don't have any distribution costs, and we also do not have other operating expenses. Okay, and there is no indication that there was a revaluation conducted in the current year. All right, so therefore we have a total profit for the year for the group of 6,385,256 rand. Okay, after we have eliminated the necessary intergroup portions. All right, Now, this particular section right here is vital when drafting this group financial statement. Okay, you need to split the total comprehensive income attributable to, or you need to split that amount between the parent and non-controlling interests. And the two amounts that you use here will be calculated in the analysis of owner's equity. Okay, now the easiest route to follow will be to first calculate the non-controlling interests amount and then just calculate the owners of the parent as the balancing figure. Alright, so before we can finish this section right here, we need to go back and finish our analysis of owner's equity. Okay, and we need to focus on the current year section, meaning this section right here. Okay, profit for the year after adjustments and provision for preference dividend. Again, preference dividends are only dealt with in learning unit 9. Alright, so we will focus on the profit after tax. And according to additional information point 3, you may assume that the current year's profit for the subsidiary amounts to 3,312,800 rand. So they have given you the profit after tax for the subsidiary for the current year, which is 331,800. Please bear in mind that you could have calculated this amount just for confirmation. Okay, the profit after tax for the subsidiary, and you would do that as follows. You would add up all the income items for the subsidiary, okay, REIT Limited. So you will take revenue and add other income, and then you will just subtract all the expense items. So that will be finance charges, cost of sales, as well as other expenses. And finally, because we are working with the profit after tax, we need to subtract the income tax expense as well. Okay, so again, if you just want to confirm this amount right here, or the correctness thereof, I've also included this in the suggested solution that I have posted on the Telegram group. It is available under files. We will take revenue of 7.93 million. We add 185, subtract finance charges of 30,000, subtract cost of sales 3.14 million, subtract other expenses of 375. Remember, dividends paid is not an expense item. And then we just need to subtract the income tax expense as well, and that will give us the profit after tax of 3,312,800. But it has been given in additional information point 3, so there has not been a requirement to calculate this amount. Okay, this amount was given, and this will be split between the parent and non-controlling interests. So the profit for the year after the necessary adjustments, because if you have unrealized profits or losses that were made in the current year and affected the subsidiary, this will affect the allocation of the profit for the year. But again, the details thereof will be addressed in learning unit 7. Okay, just take note of that as well. So the total comprehensive income that is attributable to NCI for the year, because there has not been any reevaluation surplus for the current year, is thus 993,840. So in your consolidated statement of profit or loss and other comprehensive income, the total comprehensive income attributable to NCI is 993,840. So owners of the parent will just take up the remaining amount, or the balancing figure. Okay, that being 6,385,256, and then we subtract the amount attributable to non-controlling interests. Okay, please make sure that you are able to draft this section correctly. Okay, and logically these two should add up again to the total comprehensive income for the group, okay, for the current year. Alright, then we need to complete part B of the required section, so that will be the consolidated statement of changes in equity. So let us just ensure that we have completed our opening balances. We do not have any cumulative preference shares in issue. And then the NCI balance at acquisition was 1,170,000. Okay, according to our at acquisition section in the analysis of owner's equity. Alright. Then we need to look at changes in equity for the year. And it is very important that you split these amounts correctly. Okay, between profit for the year, and other comprehensive income. Again, there was no other comprehensive income for the group for the current financial year, so this calculation should not be that difficult. Okay, so according to our consolidated statement of profit or loss and other comprehensive income, the DCI that goes to owners of the parent is 5,391,416. Okay, so this will be shown in the retained earnings column in the consolidated statement of changes in equity. So 5391. Okay, 5391416. Okay, let me just make sure that we have calculated that correctly. 5391416. Okay, remember there can be a question where there was other comprehensive income for the current year. So therefore, this amount right here would include the other comprehensive income portion as well. Again, if you want to look at or study the treatment of other comprehensive income, this has been addressed in many of my lessons that I've already uploaded on the YouTube channel, so please work through those lessons if you want to look at how you are supposed to calculate this section right here where there has been other comprehensive income for the current year. Right, so the portion that goes to the parent is credited to the retained earnings column for the group, and then the portion to NCI would be shown in the NCI column, so 993840. Again, you should ensure that the total comprehensive income for the year as reflected here should correspond to this amount right here. Okay, just for correctness. Okay, and then we need to take into account any dividends paid. Remember that we have already eliminated the dividends paid by the subsidiary, but the portion that was paid to NCI will need to be shown in the NCI column. So dividends declared and paid ordinary for the non-controlling interests was calculated as 27,000 according to our analysis of earnings equity right here. Okay, and then your intergroup portion, so the portion that was paid to the parent, has already been eliminated in the consolidated statement of profit or loss and other comprehensive income. Okay, and remember that the dividends paid by the parent does not contain any intergroup portion. Okay, so the full amount of dividends paid by the parent will be shown in full in the retained earnings column. Alright, in this financial statement. And according to our extract, the dividends paid by the parent amounted to 30,000. So 30,000 will be subtracted in the retained earnings column of the consolidated statement of changes in equity. Alright, so total equity for the group as at the 28th of February 2023 should amount to 12,048,256 rand. Okay, again, we do not have any preference shares that we need to take into account. And now we need to complete our consolidated statement of financial position, only the total assets section. So property, plant and equipment is calculated as follows. We will have 4,135,456 for the parent, plus the amount for the subsidiary 7,483,912. Okay, again, there can be an intergroup sale of a PPE item, of which the unrealized profit or loss must be eliminated, as well as the unrealized depreciation. Again, this will be addressed in Learning Unit 7. Okay, it falls outside the scope of the first assessment. So 4,135,456 plus 7,483,912. So that will give you the total property, plant and equipment value for the group. Again, according to our extract, these amounts will be shown at carrying value unless they show the cost and accumulated depreciation separately. Okay, remember that the property, plant and equipment line item should be shown at carrying amount at year end. Alright, then we have our other assets that we need to consider. So let's look first at inventory. Okay, so inventory will be as follows: the value of the parent plus the amount for the subsidiary, which is 990,000. Okay, this will give you the total inventory for the group. We'll just add another zero there. Okay, so 2,070,000. Right, so we can cross those two amounts out. Then we have trade and other receivables, 865 plus 848,888. Let me just make sure. 848,888, yes, that's correct. Okay, that will be your trade and other receivables for the group. So 865 plus 848,888. And then your cash and cash equivalents will be Bank Luno. Remember, if it's shown in brackets, it normally indicates a credit balance, whereas an absence of brackets will be a debit balance. Okay, so in other words, these two amounts right here will be favorable bank balances, so therefore they are shown as cash and cash equivalents. So 345 plus the amount for the subsidiary rather, which is 180. So 345 plus 180. 345 plus 180. This should give you 525. Alright, and then you also need to take into account the other assets that are shown in the extract. We have other investments for the parent, which is 200,000, so we need to show that amount as well in our total assets section, specifically under non-current assets. Okay, and remember that if you have an intergroup loan, okay, so a loan that was granted by one company in the group to the other company in the same group, okay, it's an intergroup loan. Now remember, from the group's perspective, the group cannot grant a loan to itself or receive a loan from itself. Okay, so any intergroup loan balances must be eliminated against each other, meaning this loan receivable from REIT Limited, which is 400,000, corresponds to the loan payable by Prospectus Limited. Okay, or the loan payable to Prospectus Limited. Okay, so in this case we can make the conclusion that the parent Prospectus Limited has granted a loan to REIT Limited amounting to 400,000, because in REIT Limited's records this is shown as a liability, which means that REIT Limited has an obligation to settle that loan, whereas in the parent's records this is shown as a receivable or an asset, because again Prospectus Limited has granted the loan, so therefore the parent is entitled to receive that capital amount plus interest if applicable. Alright, now because these two items are common items from the group's perspective, they are just eliminated against each other. So in your consolidated statement of financial position, you cannot have any of these two amounts shown there. Alright, the elimination will be done as follows. You will debit loan payable to Prospectus Limited. So you will debit the liability of 400,000 and you will credit the corresponding receivable. Okay, that being loan receivable from REIT Limited 400,000. Because again, from the group's perspective, it cannot have a loan with itself. Okay, you need to think about it in that way. Okay, so we have worked through additional information and we have completed our required section. Remember that you are not required to draft the equity and liability section. Okay, so please do not draft that section if it is not required. Yeah, and you will notice in my other lessons as well, I normally draft each of the three statements in full. Okay, but I want you to only focus on what the required section has stated. Alright, and please compare this lesson or the figures that I have presented in this lesson to the suggested solution document that I've posted on the Telegram group. You will find it under files. I think I've posted that solution somewhere in March, as far as I can recall. Alright, but total assets for the group should be 16,398,256. And just make sure when writing assessment 1 that you convert all your answers or calculations into one PDF file. Alright, and please refrain from continue writing up to the last minute, meaning give yourself a reasonable amount of time to submit your answers. And please refrain from cheating. Okay, cheating. Do not buy answers from any third parties. Make sure that it is your own work that you are submitting for grading. Other than that, thank you for tuning in to this lesson. I hope it has been helpful, and I want to wish you good luck, or I want to wish you all the best with your preparation for assessment 1 that will take place on the 22nd of August as per the latest information that I've received. You are more than welcome to message me on Telegram if you have any or any obstacle that you struggle to overcome with respect to the module content. I will help you as soon as I can. Please take note, however, that I am busy with my final year modules and they take up all my time. Okay, you will notice that this is the first video that I've posted in months. Okay, so please be patient with me. Again, the videos are accessible on my YouTube channel. They are free of charge. They are meant for your assistance, or they are meant to help you along with your FAC2602 journey. So that is all from me for today's lesson. I wish you good luck, and once again, take your time on properly working through these lessons. Do not rush through these lessons, and please exercise patience when working through past questions, because you will come across certain aspects of a question that will, or that might throw you off guard, or might catch you off guard. I will see you in the next lesson. Goodbye.